Talk about EVs.
Yes.
And not just Tesla.
Yes.
Is it good news for Tesla what's happening in Detroit right now?
Yes, because if there's a strike, of course, there will be more production shortfalls. I think that there's just now the supply chain has freed up, so unfortunately we'll have all kinds of questions about that. But I don't think it has anything really to do with the strike. It has everything to do with a consumer preference shift towards better vehicles, electric, that are falling in price. Tesla is leading that price decline simply by passing cost declines on to its customers. So I think that's what's good for Tesla.
The complaint we hear is that people can't afford these vehicles. What we're seeing in the news
changing.
In the UK, as you can see, Rishi Sunak is pushing back targets to get rid of all of these internal combustion engines to 2035 from 2030. Are we being unrealistic about this transition and how difficult this is going to be?
No, we do not think so. We actually, the total cost of ownership, now this is in the United States, it's a little bit different here, but the total cost of ownership of an electric vehicle fell below that of a gas-powered vehicle about 2 to 3 years ago. Soon, sticker prices.
Does that include insurance?
Yes, includes insurance. Yes, as I said, local differences, but yes, in the United States, that does include insurance. And in fact, Tesla is so sure that its cars will have fewer accidents and fewer fatalities that it's willing to provide insurance. So yes, that does include everything, all in.
You were at USC, you didn't get a B. Laffer called up Robert Kirby at Capital Group and said, just shut up and hire her. So you walk into Capital Group, which is the land of an R-squared and 98 Washington Mutual Fund Investment Company of America. Yes. Everything is completely diversified out. You're the polar extreme. They threw you out. You almost fell into the Pacific Ocean. They were so upset with you. So you go out and you say, I'm not going tight R-squared to SPX. I'm going out and do my own thing.
Yes.
People have prospered off of innovation and technology. How does that continue in America? Can you be less diversified and win 5 years out?
Well, you mentioned Capital Group, and that is where I did start my career. And that is where I saw tremendous research and a long-term time horizon. So really what we're doing with ARC is just going back to the future. My initial experience, which was in the late 70s when I was in college, and we're doing deep research, first principles based, white sheet of paper.
But you're away from an R-squared like Washington Mutual or the other funds. What's your R-squared right now?
To be honest, the correlation of our performance to broad-based benchmarks is very low, for better or worse. What it tells our clients and prospective clients is we have a very good diversification strategy. Our funds, the active weight, if you're comparing to MSCI World or S&P or NASDAQ, the active weight is less than 5%. So really good diversification strategy, focused on companies that are going to transform the way the world works. We look at the broad-based benchmarks, and sure, there are companies that are sustaining innovation like an Apple, but they are not going to transform the way the world works from here. Our companies are. We've always invested for the long term. And what interrupted what was a very nice move up in innovation stocks, especially disruptive innovation, was a massive increase in interest rates, the likes of which we have never seen.
Of course.
24-fold increase. So all long-duration assets, especially in 2022, were destroyed, including bonds, which are usually a flight to safety. They had their worst year last year since the 1700s. There's no way in that environment that our strategy would have done well. But I do think that what's happening this year is that the market is starting to look over the Fed's moves, whether there's one more or not, into falling interest rates. You know, we started underperforming in 21 just with the anticipation of rising rates, and even more so in 22.
So how are you going to change? I want to know how you're going to change the sobering quarters you've been through. What is the new Cathie Wood approach to macroeconomics, frankly, pandemic economics, intruding on your belief in innovation?
if anything, innovation gains traction during tough times. And if you look at how the reason our portfolios are outperforming this year is, it is because they are gaining share in what is becoming a difficult environment, right? And so one by one, we're going to earn our way back, and it's all about revenue growth, margin expansion.
In the Wall Street Journal, they do a fabulous thing with old farts like me, and it's people with over $5 million, and they believed in Cathie Wood. To a person, those retirees bought innovation, they bought tech, they bought Apple, and they didn't listen to financial TV or radio. Can you do the Cathie Wood approach for 1, 3, 5 years, given the volatility you've seen?
Yes, I think we're on the other side of that massive interest rate increase, which did destroy a lot of performance. That's the most important thing. And we are ready for prime time. Many people are concerned about our kind of strategy, and the company we just acquired, Rises, because in Europe, in London here, for all of Europe and UK, they're focused on global megatrends as well. And you know, interest rates hurt everyone in that space. If we are right, and rates are going to come down at some point in the next year, you know, the market is a discounting mechanism, then I think that the muscle memory that hurt our strategy, and it all has everything to do with the tech and telecom bust, and people thinking, oh my gosh, are we here again? No. What happened during the 20 years that ended in the tech and telecom bubble is the seeds for what is happening now.
Right now, what's happening is Elon Musk's Tesla stake is soaring and getting closer to what he actually demanded. The Tesla CEO recently said that he wants a 25% stake in the company, or he'll build AI and robots somewhere else, because without a 25% stake, he doesn't feel comfortable to do something so big that could potentially be dangerous someday. Well, as of right now, Tesla CEO Elon Musk now owns a 20.5% stake in the company, according to a new SEC filing, meaning the world's richest person is close to his demand for a 25% voting control of the EV maker Tesla. Elon Musk's stake in Tesla, which was previously reduced to 13% after he sold tens of millions of shares in 2022, mainly it was to finance his acquisition of Twitter, which is now known as X, is made up of 411 million shares of Tesla common stock and options to purchase 304 million shares of common stock exercisable within 30 days of December 31st, according to the filing on Wednesday. And in January, Elon Musk posted on X that he was uncomfortable growing Tesla to be a leader in AI and robotics without having 25% voting control, which he added was enough to be very influential, but not so much that I cannot be overturned. We should also remember that Elon Musk was also one of the guys who co-founded OpenAI in 2015 before leaving in 2018, said unless he got his desired stake, I would prefer to build products outside of Tesla. In April of 2022, Elon Musk said an interesting prototype of a robot he was developing called Tesla Optimus would be ready that year, and the production of that robot, which would perform house chores and which would perform all the daily activities you would do in a house, would start within 2 years. And in July, Elon Musk said that Tesla was investing up to $1 billion in Project Dojo, a supercomputer with machine learning features to store and manage data generated by its millions of Teslas around the world. But a larger stake for Elon Musk would also give the billionaire a larger payout. A Delaware state court judge late last month struck down Elon Musk's $55 billion paycheck from 2018 that cemented his place as the world's richest person. Elon Musk has moved to reincorporate both Tesla and SpaceX in Texas in response. Tesla stock, which has struggled mightily to start 2024 on its way to the bottom of the S&P 500 index, was up 5% on Thursday alone. So, like I said, it doesn't take a lot for Tesla to start getting momentum and get up to like 15-20% in 1 or 2 months. So we'll have to see what happens. Well, Cathie Wood buys Tesla stock as stock tumbles 25% this year. ARKK and ARKW have bought nearly 700,000 shares so far in 2024, which is quite a lot. And Tesla stock has tumbled on growth concerns and demand slowdown. So why did Cathie Wood want to buy Tesla stock? Was it just because of the dip? Well, it seems like Cathie Wood is just buying the dip in Tesla, even as Wall Street is not very happy with the stock right now. And the fund manager, Cathie Wood, has swooped up nearly 700,000 of the EV maker across 2 ETFs operated by her firm, ARK Investment Management, in Jan. The ETF spent an estimated $141 million on those shares, so they certainly bought a lot of them, according to the calculations by Bloomberg based on shares closing price. And Cathie Wood has been a long-time Tesla bull, but had mostly sold shares for 3 straight quarters before the current buying streak. So is this exactly just buying the dip? And her flagship ARK Innovation ETF, ARKK, and the ARK Next Generation ETF, ARKW, have Tesla as their 3rd and 6th largest holdings respectively. Well, we should remember that a couple of years before, Tesla was always the number 1 position. And Tesla has dropped 25% so far this month as the auto industry warns about plugging demand for EVs, and Wall Street analysts scale back expectations for the stock. And Cathie Wood's flagship fund is down nearly 10%, but that's after it gained 68% in 2023. Cathie Wood had a pretty decent 2023. Cathie Wood's ARKK falls after a massive 2023. The flagship fund is down nearly 10% for the year so far, but it went up almost 70% in 2023, which is pretty great. And Tesla shares have tanked after Wednesday's Q4 earnings report, when the company said it expected to expand at a notably lower rate in 2024. So Elon Musk almost just said that 2024 is not going to be great for Tesla, and so the company lost almost 25% in Jan, but Thursday alone the stock did pretty reasonably well, and I don't know, going 5% up in one single day, and I think it will go up another 5% this week. So yeah, if I could make 10% from Tesla stock in a week, I take that. And Cathie Wood has been a long-time big fan and supporter of Elon Musk's EV company. ARK's research team projects the stock will hit $2,000 by 2027, which is just 3 years away. So Cathie Wood still believes that Tesla stock can go 10% higher from where it is today in just a matter of 3 years. Am I a big believer of Tesla stock? Yes, I am. But do I believe Tesla stock will go up 10 times in the next 3 years? I don't think so. I think Tesla stock would be around at $500, $600 in 2027 if everything goes Tesla's way. But one of the main reasons why Cathie would believe so is because Tesla's robotaxis business is a key driver. If Tesla's self-driving software becomes a reality, Tesla could easily 5x from where it is today, because that is a completely different source of income. And the investors often say her firm backs companies poised to change the world. And she always has a 5-year investment time frame. But apart from calling Tesla, I don't think Cathie Wood has done that great, but that itself has made Tesla and Cathie Wood a lot of money. And we think it shows conviction in the long-term story, and we believe a lot of investors were waiting for a buying opportunity after Tesla shares more than doubled last year, and said the vice president and senior analyst at CFRA Research. I think that is true. Even if a lot of people are not very bullish on Tesla stock, and if Tesla stock goes down 20-30% in a month, everyone would want to buy the dip and make 10 to 15%. And they're getting that opportunity now with stocks year-to-date sell-off. Well, Elon Musk's Tesla generated a substantial $1.8 billion from carbon credit sales last year, as revealed in their Q4 2023 annual financial report, bringing its total earnings from such credits since 2009 to nearly $9 billion. And this revenue comes from trading regulatory credits to other automakers unable to meet emission regulations in the US, Europe and China. And carbon credit cash flow, Tesla's billion-dollar bonanza. Well, Tesla continues to profit from the need of its rivals to meet emission standards, and it is a lucrative business that was initially expected to diminish with time, since the EV giant incurs minimal additional cost to earn these credits. The sales represent almost pure profit, and this revenue stream has been very crucial for Tesla, although the specific recipients of the credit remain undisclosed. In the recent Q4 and annual 2023 filings, the EV maker Tesla reported a $433 million income from the sale of carbon credits. That figure represents a 7% decrease year over year compared to $467 million earned in Q4 of 2023. But the annual total revenue of Tesla from selling carbon credits in 2023 increased to $1.79 billion from $1.78 billion. Yet that enabled the automaker to reach another record high in 2023. This sustained revenue may have surprised Tesla, given previous expectations that regulatory credit income would fall as competitors increased EV production. And in 2020, the company's former CFO Zachary cautioned investors about relying too heavily on this revenue stream. He forecasted a decline in its significance over time. However, contrary to expectations, Tesla's earnings from regulatory carbon credits have not decreased significantly, as last year's earnings slightly surpassed the previous year's income. Well, to be precise, Tesla is driving the carbon market forward by providing its peers a mechanism to offset their carbon emissions. Tesla plays a significant role in the carbon credit market, as the automotive sector seeks to comply with emission standards set by regulatory bodies. They can purchase carbon credits from Tesla. They can also do the same from other companies that reduce greenhouse gas emissions through renewable energy and other carbon reduction or removal initiatives. The revenue generated from the sale of carbon credits has become a substantial source of income for the company. And in fact, the credit accounts for a staggering 11% of Tesla's overall gross margin for the quarter. Well, still, the growing carbon credit sales underscores the value of EV makers' clean energy initiatives. This is also evidenced by another growing business of the company, energy generation and storage. Given the global focus on reducing carbon emissions and addressing climate change, the demand for carbon credits is expected to increase in the future. And Tesla's position as a leader in the electric vehicle market and its commitment to sustainable energy places it in a favorable position to continue profiting from the sale of carbon credits in the years to come.